We're here on show 3 of Moomoo Investment Outlook for 2024. Now, what is this topic is all about? You're going to have to stay tuned once again. You're here with me, Olivia Higgins. Welcome back, everyone, for the second show of the day, but the third show for our entire series that we have crafted and created just for you. Now, if you want to find out who we have on here and also the topic for discussion, stay tuned and enjoy this video. Welcome back, everyone. Once again, you're here with me, Olivia Higgins, and today we're on to show 3. Welcome. Have a virtual seat with us because today's topic is going to be really exciting. Before I introduce that, here's a reminder just for you. As always, it's all about networking today, okay? Do not take anything as financial advice or recommendations. Use this time, though, to really utilize it to learn for yourselves and to really engage our expert that we have for you today. So if you are typing in the chat box right now, if you've just tuned in, type in yes if you're excited for what we're about to discuss today and whether you're ready to learn. Now, I'm going to remind everyone that just like the previous shows, to really reward you for being here with us. It's all about engaging, but at the same time, also learning for yourself. So we're going to have some surprise giveaways, okay? So you have to pay attention to what our expert shares in terms of insights. And also, if you ask questions, if we pick your question, you'll also be rewarded. So definitely have a think about that. And we'll use the second half of today's live show for the questions. Let's get straight to it. Today, it's about the time-tested approach on quality investing. So with that, I'm really pleased to really invite for the first time our guest onto the show. Let us welcome portfolio strategist on GMO's focus equity team, Gunwoo Lim. Hi, Gunwoo.
Hi, Olivia. How are you?
Welcome to the show.
Thank you for having me here today.
Now, to the audience members who are seeing you for the first time, we're really excited to see what you're about to share with us. But at the same time, tell us about yourself.
Oh, yeah. My name is Gunwoo. I'm a portfolio strategist of the focus equity team at GMO. I started working for my company since 2011 after I finished my master's degree in the States. And I moved to Singapore, and ever since I working for the firm. And previously at GMO, I was part of the team managing emerging market equities. And recently, I moved to the team that managing global equity, and which is a focused equity team at the firm. Yeah.
Right. So when we talk about GMO, right, they're widely known as a value investor in the industry, also one of the pioneers in this space. So for those who are unfamiliar with GMO and what they do, could you tell us more about this?
Yeah, sure. GMO is a global asset management company. We are headquartered in Boston, but we have offices around the world, including Singapore and like London, Sydney, and Berkeley offices as well. So we have about $60 billion US in assets under management, and we have about 100 plus investment professionals as well as 11 investment team that managing different strategies across the asset classes. And if you put into the next slide, we have different products, across different asset classes. Today, specific, product and strategy I'm going to focus is actually our flagship equity fund called Quality Strategy, managed by the Focus Equity team. So next slide about, Focus Equity team, who manage that strategy. The Focus Equity team is consists of about 15 investment professionals with, 5 members being partner of the firm, and the portfolio managers are long tenured, working together over 20 years in time. And the flagship strategy, the quality strategy is about $15 assets under management. It's largely a global equity, high conviction portfolio. Today, I'm very excited about share more about how we go about quality investing, how we implement that strategy in a product.
Now, quality investing, I know we have a mix. We always do in the audience of both active investors, intermediate and also advanced, but at the same time, the new investors coming in. So let's really widen this topic of quality investing. Now, what can the audiences expect with this space? Why they should be listening to this particular component? But more importantly, what is GMO's take on quality investing?
Sure. Let me just start straight with the performance. Why we believe that the
Mm,
quality investing is a time-tested approach. If you
mhm.
see that slide number 5, we have started, this strategy since 2004, and next year is about our 20 years anniversary. And you can see that over the long, term, we have delivered a compounded our wealth over 9.3% versus 7.2% benchmark. And we have delivered that strong performance with much lower risk than the benchmark, measured by the absolute volatility less than 13%, and the benchmark volatility of greater than 15%. And one of the nice interesting characteristic about quality performance is that in the up market, our portfolio have perform in line with the benchmark. You can see in the chart on the right-hand side. Whereas in the down market, we lost a lot lesser than what the market lost. So over the long run, because of the compound effect kicks in, you have outperform your benchmark or your peers over the long run, because we have avoid this major bear market. And you can see that this is very live stress test coming from the major bear market: 2008 global financial crisis, 2011 European crisis, and 2020 COVID-related sell-off, and last year growth-related sell-off. All this like bear market that down more than 20%, we were able to deliver the very stronger return than market, because we buy only quality business with very attractively priced investment. And you can see the next slide, by a different period of time, 1, 3, 5, 10 years time, we have delivered very stable performance, and even calendar year, almost every year in the past 10 years, to have delivered a stronger return than the market. So we really think that this quality investing is a very time-tested approach, and we have delivered that performance over the 20 years with a live track record. And today, I'm really excited share about how we go about it.
Thanks for that. So you've highlighted not just, what they can expect from quality investing, of course, GMO's background, but also, in terms of how they can approach it as a value investor. So really, Gunwoo, what I'm really asking for today is, the perspective of GMO on this before we proceed into the particular strategies that our investors tuning in can look out for.
Sure. I would start with, what is really quality business? Because there are a
Mm,
lot of definitions about, quality business, and some, probably, there's common kind of understanding of quality business is company with very strong fundamentals, with a decent management quality. So that when you identify quality business, we look for really the 3 key criteria. The first criteria being, we want a company to have identifiable high returning asset, measured by return on capital and return on equity, and that type of ratio. And when I talk about these high returning assets, it could be tangible assets or as well as intangible asset. And intangible assets, can be like brand loyalty or the market share or how sticky their business model is. That type of all these kind of characteristic of the high quality company contribute to have the wide economic model of the business, so that the company's long-term profit can be protected from future competition. So that company can grow or reinvest their earnings at the higher profitability, so they can grow higher than the market average. So that is the first criteria we think that is very important to have as a high quality. And second criteria is about their business model. When you're talking about the business model, we want to have a company that business model will be relevant enough in the future that their profits, we can project their future profits with a reasonable confidence. So let me give you a good example. So Microsoft is our top holdings over the years. And as a Microsoft user, as a corporate world, you cannot really imagine a day without any Microsoft Windows or applications or cloud service. So, we can reasonably sure that next 5 to 10 years, when you project their, future earnings, Microsoft business model will be still there. There are, some new player coming into the market, but because their stickiness of business, we believe that Microsoft earnings, we can forecast with a reasonable amount of confidence. So that's why I think about, that high profitability with a reasonable amount of confidence for the future business, outlook, we can, kind of come to reasonable valuation for the stock. And lastly, the characteristic we're looking for is management of capital discipline, that we want companies to reinvest for future growth rather than, going for some less attractive investment in the market and etc. So if the company have demonstrated their strong capital allocation ability, and that is the kind of criteria we look for quality company. So let me just move on to the slide number 8. You can see what are the the characteristic they have demonstrated over the years. So the GMO at the firm, we came up with these 3 identifier to identifying the quality company in a systematic fashion. And you can see that is what I just mentioned, the high profitability and the stability of that profitability and clean balance sheet, meaning the company doesn't take too much leverage on their balance sheet. And the chart on the right-hand side, how they have performed historically. And the chart on the left side, the dark blue line, you can see that over almost 100 years of our market history, these quality companies have demonstrated slightly better than market return, but not very decent return, but better than market return. But what's really interesting in the pattern of their performance is that during the bear market, they done a great job of protecting capital compared to the broader market. And as a value-oriented manager, GMO, we were interested in the intersection of that value and quality. So what we did, what if you buy that cheap half of that quality universe? Would that improve your performance or it detract performance? The result is in the right line in the green bars here, that it actually enhances your return, long-term returns, as well as it also protect your capital even better during the bear market. So that is really the bread and butter of our quality strategy. What we're really trying to achieve in this portfolio is that we identify highest quality company in the world, but we buy them at very attractive valuation. So that is kind of investment thesis of our strategy, and I'm very excited to show about how we go about it very quickly. So Olivia, is the audience following me?
Absolutely. Now, so far, I think the audience already has questions for you. Now, if you are loving this topic on the time-tested approach for quality investing, type in yes in the chat box right now for Gunwoo, because of course he's highlighted the fundamentals and also the key characteristics to look out for when you start off in this space. And now we're more transitioning into more the application and strategy of it. The floor is yours, Gunwoo.
Sure, yeah. Let's look at slide 9. I guess I particularly think that this is a great kind of slide that you can also apply on your personal investing. How you go about before you invest stock, what kind of process do you follow so that you kind of minimize your making error or mistake for personal investing. And the way we do in our GMO, the focus equity team, is that we start with about 2,000 liquid securities given the size of our fund. And what we do, as I previously mentioned, we use quantitative screens as well as our fundamental analysis that we run this quantitative screen on over these 2,000 securities, and that throw out based on that historical financial data. These are the companies that historically demonstrate quality attributes, but that might be the quality university in the future or may not, because that depends on the historical data. So what we do as a human fundamental analyst is that we deep dive into this kind of unbiased quality prospects, and we decide what are the quality companies that likely stay in the quality in the future, and what companies are unlikely make it to the qualities in the future. So we differentiate this quality unbiased raw universe into the quality true quality company based on our assessment. And we deep dive into our valuation work and what are the quality companies that reasonably or attractively priced, and we create the final portfolio around there with the 40 to 50 very high conviction names. And the next slide is the illustrate example and real world example. Some of the stocks that is listed in the next slide is that they all made into our quality universe. So slide 10, if you show, but some of the companies listed here didn't make into the final portfolio. And let me explain why. For example, Intel has passed the quantitative screen, but during the fundamental quality vetting, it actually didn't make into the final quality universe. The reason is because the chip space, chip industry that Intel has been successful in the past, that competitive landscape have changed significantly, and we don't think that Intel doesn't necessarily lead that new competition. That's why we believe that Intel may be a hard time in the future than what it had in the past, because the new competition has emerged. So Intel is kind of out from our fundamental quality vetting process, whereas Hermes, the luxurious brands that we own, we passed the high quality fundamental vetting process. We think that it is high quality company because of its dominance in the luxurious market and brand loyalty. But what kind of concerns us that basically how much you pay for that investment, right? The great company doesn't necessarily a great investment if you pay too much for them. So Hermes at this price point, we don't think that we can make much money out of it. So that the Hermes didn't really make into our final portfolio. And Coca-Cola and Pepsi are an interesting example. They both have very similar business model in the market that they play, and they all passed our fundamental quality vetting as well as the valuation work. But we chose Coca-Cola in the final portfolio because we think that Coca-Cola has slightly higher quality than Pepsi because of its market share as well as dominance in the beverage industry. So all in all, this is kind of how we go about every investment process that I explained earlier using the stock example. I thought this could be useful for the audiences today.
Absolutely, Gunwoo. And we already have some burning questions for you coming in, but we'll answer those questions of the second half of the live show. Okay, remember, you got to stay till the end because we got some giveaways for you. And if your question gets picked, you will definitely be rewarded as well. Next question, Gunwoo. Now, you mentioned the mix and the blend of the quantitative discipline and fundamental analysis as the key differentiators. So can you just elaborate more on how the combination actually benefits your decision-making process as a whole?
Yeah, sure. Having quantitative, like skill set as a team is very unique in a sense of the fundamentally driven strategy. I'll tell you why. That humans are very good at deep dive into specific company or specific industry, but because of our brain cannot digest too much information in very fast manner, but we use machines computing power to throw out quality universe, unbiased universe that, okay, this is a metric that we think that fit as a high quality, then give us the list of names, then we will see whether this is actually truly the company or not. So that kind of, we believe that the fundamental process as well as the quantitative process complement each other. In the other way, quantitative process has its own limitation too, because they use our historical data. They tend to be a little bit backward looking in nature. So as a human, we can kind of understand whether what the computer, the quantitative system, screening throughout the names will be staying high quality business in the future or not. So that kind of the interaction of this, quantitative process and fundamental analysis is a very important piece of our investment process.
Absolutely. Thank you for that great answer. Also very comprehensive for our audience. Next question then. You mentioned in slide 5, you delivered a strong performance since inception of this with much less risk in the portfolio measured by absolute volatility. Now, how do you manage the risks in the portfolio?
So yeah, I think it's a good question. So when you think about portfolio risk, there's multiple ways you can measure and manage. But at GMO, at Focus Equity Team, the way we approach the portfolio risk is from a fundamental risk point of view. So when I say fundamental point of view, it could be some as opposed to statistical point of view where some managers manage their portfolio through portfolio beta or standard deviation or correlation and etc. Or sometimes the sector exposure or country exposure. But the way that we manage portfolio risk fundamentally is that let me give you an example of Apple and like Lam Research, in the tech industry or Texas Instrument. These companies all listed in the States. But what are the kind of a common risk they share as a in a company? If you don't understand every single inside out of the company, you wouldn't probably see this type of portfolio risk. What they share in common is actually China, exposure to China, because they have quite a significant portion of their business coming out of China. So when China slows down, these companies likely get impacted. So having that understanding of your fundamental side of your investment is very important to managing portfolio risk. And this is the way we tend to manage our portfolio risk, and our low volatility, low beta is the result of our managing the risk through this fundamental lens rather than statistical targets.
Absolutely. So let's talk about markets, Gunwoo. Now, 2023, what a year it has been. And again, back to the topic of today, we're going into the outlook for 2024. And of course, the time-tested approach on quality investing. Now, we've had quite an interesting year, Gunwoo. Am I right?
Yeah, it is interesting.
The
Every year is interesting.
Recessionary fears. We've got the hikes within the US Federal Reserve. And then we've also got all the other macro geopolitical tensions and revelations that have happened. And most recently, of course, in the tech sector with the different sagas that we see. Now, we're looking at all these risks around us, on a global level. Now, could you share some of the key concerns and risks that our investors should look out for from, the equity market point of view? And at this point of the cycle, are there any, insights to share for equity investors?
Yeah, sure. I can share my views of the market at the moment, also my team views or fund views. But before I get into that specific views, I will kind of want to give good advice for our audiences today. So one of the risks of following like professional investors' view or investor gurus' view is that, like a great example would be last year around this time, there was a survey from professional investor that whether we have a recession in 2023. But more than 2/3 of professional investors said yes. And if you follow professional investors' view on the market, and then you position your portfolio defensively, reducing your equity exposure, reducing your tech exposure, and etc., then you would have missed a lot of returns this year. Strong market, right? And the point here I'm trying to say is that creating your portfolio, adjusting your portfolio depending on market views might not necessarily lead into greater return in investing. Instead, what you can do is that you try to build your portfolio as resilient possible that can perform regardless of a market conditions. So here, what I'm getting into that is diversification is the key to your kind of investment, and that's exactly what you do at GMO at Focus Equity. If you see slide 11, this is how our portfolio look from different sectors and different style. Slide 11, please. I haven't it's show up yet. So yeah, you can see that, we own about 40 to 50 names, very high concentrated portfolio. But what we are trying to diversify in the portfolio is that what are the, your exposure to different business model? What are your exposure to different styles of the market? Because, sometimes some year your growth stocks do well, some year your value stocks do well, and vice versa. You have a bull market and bear market. So what we're really trying to do is that we bucket our portfolio holdings in three different groups, which is core quality, quality value, and quality growth. And core quality is about, steady compounders. Some of the usual names that Nestle over the world and Johnson & Johnson over the, in the healthcare, that might not be the, fastest growing quality company, but because their business model is so stable and they're quite well protected from the new competition, that these companies tend to grow slowly but steadily. So these companies probably least sensitive to macroeconomic condition, and they tend to perform best when the markets are under stress, like years like last year. Whereas the quality value piece of our portfolio is interesting. They are more like contrarian mindset where, some of these high quality cyclically oriented companies trade at very attractive, valuations. So years like, COVID time, 2020, if you recall it, everybody, because it's something new risk to the market, is everybody have hard time, digesting what is the implication to, to the market. Do you remember that? And the
Yes,
answer,
absolutely.
some of the
That's a really
companies like,
important scenario.
exactly, travel-related companies, like aerospace-related companies, were trading at very compelling, valuation. So what, as a, like quality manager, we know that this is, they are the, very good quality companies. This valuation is just too attractive to ignore. So we bought some of these, these, the aerospace, jet service companies, Safran, and names like that. And what happened last year when everybody kind of forget about COVID and economy back to normal? These stocks performed a lot better than the tech companies last year. So, and then last piece of that, our portfolio group, the quality group, is that quality growth group, where these are the sort of fastest growing the groups of the stocks of the in this quality universe, but they might not seemingly very cheap because they're usually trading at very premium multiples over the market. But the reason we hold into these names is because if you really understand their business model and long-term growth projection, and you really discount their future cash flow into the current prices, they're still reasonably to attractive value. Although there are many names, market currently darlings of the market darling stock of this year is like Nvidia might not fit into that quality growth stock because it's too expensive. That's why we don't own it. But there are a lot of names that tech companies that's still looking attractive in that space. So we own this diverse set of stocks in the groups of stocks in the portfolio that benefited over the long run. Yeah. So again, back to your question, it was long answer, but back to your question. Yeah, we do see some of the risk in that portfolio in terms of valuation. Like as you mentioned, market does look expensive on average basis, but because it's because some pockets of the market have done really well. They did the heavy lifting of this year from the return perspective. So stocks like Nvidia, we think that the valuation looks quite, like stretchy. So that's why we think that it's a great company, but we don't own because of valuation issue. So when it comes to your investment, you have to be careful with what you pay for. The great fundamental business is not necessarily great investment if you pay too much for them. And other than valuation concerns, some of the geopolitical concern between China and US is still ongoing. It doesn't look like it's going away anytime soon. And some of the interest rate, that new normal, that stay higher for longer. So all these things together, it's kind of uncertain. I don't know, is that what kind of market we will have in 2024. So my advice for you is that you build a diverse portfolio that can perform regardless of market conditions.
Thank you for the fundamentals and also that sound advice. For the audience members, keep those questions coming. We'll answer them for the second half. Now, as you mentioned, the key word here is valuation as a key focus for quality investing. Now, after a strong rally this year for AI-related growth stocks like Nvidia, of course, we saw the boom with that. Those stocks have become pretty expensive. Now, do you own that stock in your portfolio? I mean, in that particular portfolio that we're talking about, and I'll show them how to access it after. But then, from GMO's perspective, then, how do you position your portfolio to capture that growth theme for next time? Because I had a lot of questions from the audience members, asking if it's too late to jump on the bandwagon, and is it, time? How can they enter that space? What is your advice for that?
I think short direct answer to your question is that no, we don't own any single shares of
Okay.
this quality portfolio.
Right.
But we believe that, we believe that NVIDIA is a great company. Don't
Mm.
get me wrong. It's not, we don't think it's a great company, but it's just as you mentioned, that stock
Mm-hmm.
people,
Mm-hmm.
given the size of a company, is already, I think, $1.2 trillion company. And we just think that it just valuation doesn't warrant a great return in the future based on our analysis. So instead, what we do in our portfolio is that we own a basket of very well diversified tech companies. So names like hardware side TSMC or Lam Research, that benefiting from this being an ecosystem of this AI related growth theme. And on the software side, we own Microsoft, Google, Alphabet, or Meta platforms, and the Meta platforms over the world. So what basically we're trying to do in the portfolio is that, okay, market think that this AI related growth is gonna be here quite a long period of time. It looks like structural, and we also they're part of the thesis that we agree with. But then instead of going for the most expensive, the market darling of that a stock, that NVIDIA, what is more conservative way of playing this theme? And we think that we come up with the conclusion that this historically proven high quality tech companies the way to go, and the valuation is much less demanding than the most expensive stock in this space. So that kind of conservative way of approaching that hot growth theme is our approach to that. And I would advise that investors don't feel don't feel the FOMO because you think that, oh, I missed that stock triple, but it's okay. If you just follow that kind of sentimental rational that, oh, I have to buy the stock, you chase it, it likely, based on my experience, it doesn't look like it's gonna be a good investment. Instead, they take a step back, think about how much I want to pay for this type of investment. What is my investment horizon, and do just a little bit of a math and go for conservative kind of assumptions. Then then you can probably get some of the ideas right.
Thanks, Gunwoo, for that really comprehensive. Now, I'm going to ask you one last question before we go into the live Q&A, okay? Because we have a lot of questions coming in just for you. Now, as we've entered the new normal for rates, okay, we don't know where it's going to go, right? I mean, the anticipation is there, perhaps even higher for longer. So how does that impact the quality of companies in general from GMO's perspective?
I think that, these high quality companies actually position pretty well for that higher interest rate. And the rationale for that is that, one of the characteristics that I mentioned for high quality companies that they're clean balance sheet. What really means is that, they carry less leverage in their balance sheet, so that when interest rates gone up like this year, went up like a couple of percentage point from the low, then, compared to the company with a lot of leverage, a lot of debt, that interest expense has gone up, it doesn't really affect the quality companies with less leverage. And one of the nice features of high quality companies that their ability to fund their internal growth internally using their strong free cash flow generating ability, compared to the company that have to rely on external financing, go to the bank and borrow money so that they keep investing for their future growth. So that the characteristic of high quality company that with less leverage and strong free cash flow generating ability, we believe that they're positioned pretty well for this high rate environment. I also high rates because of a high inflation expectation, right? We think that because of their dominance in the market share or the brand loyalty, these quality companies tend to pass down their inflation pressure to the end customers. So that's why there's another reason that we think that quality companies position pretty well for that higher rate environments if that is a new normal.
Thank you, Gunwoo, for that. We just had the first half of the time-tested approach on quality investing. Now you've heard the insights, but now we're going to go for our quiz giveaway. the first one out of 3, and also we'll show you how you can apply what you just learned from Gunwoo before we take the burning questions from the audience. We'll be back with you shortly, Gunwoo.
Thank you.
Okay, so you know how the quiz works. If you joined us for the previous 2 shows, this is the most exciting part. I really love it when I see the questions being answered. Now, the first 5 users who answer the question correctly, fastest fingers first, of course, our teams will reward you with 500 points in there. So really, if you have the answer, type it away and do it quick, okay? So that you can redeem this and also be a part with us on the show. This is our way to reward you for being here with us. And this is only quiz 1. So if you're ready for quiz 1, type in yes so that I know. Okay. Are we ready for quiz 1? I need to see a big yes in the chat box. Okay, let's go to quiz 1. The question is, which of the following is not a characteristic of high quality companies? Which of the following is not a characteristic of high quality companies? So we've got A, B, or C. Answer this correctly. Okay, guys, I know you've been paying attention. We've covered this at the start of the live show. So I'm pretty sure that a lot of you have got it. Okay, I'm going to give a chance to the people who are late onto this. You've got 5 more seconds. Okay, it looks like we have our winners. Our teams will be in touch. Thank you for participating. And now I'm going to show you how you can apply it. Okay, I think it's really important that when you come on these shows, you not just learn about the insights, but if you're ready to make a decision on certain things, if you want to try to apply what you just learned and also explore for yourself, right? Based on what the experts talk about, then you have to follow through with me. Very, very short demo on this. So if you got your phones, I got my phone with me right here. You open your Moomoo app, you go to watch list, and you go to discover funds. And if you see under funds, you can see the fund houses right here. So really, really quickly, now for the purpose of today, we're going to go to G for GMO. And we're going to go for the topic of today on quality investment and click on the first one. So over here, I'm just using this as an example, but this is how you can see the performance of the quality investment fund and also all the topics for discussion that we did today. Now, I am quite a detail-oriented person, so I need to always know the customization tools for me. So that's something I like to know. I like to know all my homework details before I make a decision. So you can actually just look at the different time horizons and also the trend charts according to what you're looking at in terms of time frame, right? Everyone is a different investor in this sense. You go down, you can see the historical returns, very important as a fundamental tool as well. And the position details right here, click on the arrow to see it with much more detail. Now, if you scroll to the right, you can see also like the shares change, the percentage change in shares, and also the type that is within this particular holding. Okay. So these are all the list of companies. It gets updated in real time. It's everything you need to know. It's everything at your fingertips. Now, this is just so convenient for everyone, but my favorite, definitely the comments, news, and analysis, because this is where I get to see what is, being talked about within this fund. You can see right here, we're live, right? If you click on this, it's all related to the particular fund. Everything is just there for you, makes it so easy for you to access. And news, another important tool, because you can see over here, You see 29 minutes ago, 32 minutes ago, everything is updated in real time related to this particular topic, this particular fund. If you want to see announcements, you can see it and track it over here. Right now, there's no data because there's no recent announcement, but definitely come back and track it for yourself. You can see the analysis for the asset classes and investment styles that you're looking at. So this is just something, to explore as a tool. You don't have to use everything, but it's definitely useful if you want to get a bird's eye view of the particular components you need before you make a decision. Now, summary is just a macro overview, right? So if you're looking at the fund documents, I know I get a lot of questions on this. Where can I access that? You go to that particular fund you're looking at and then go to summary and clicked on fact sheet for the details. See, it comes up straight away. You can, of course, zoom in and out. But I think essentially this is everything you need to know. And before you make that decision, you can go ahead and heart it. And if you're ready to subscribe, let's say to this particular fund, you can click on subscribe right here and it will take you to that page. I mean, it's not doing it right now, but for yourselves, if you're on your particular app, you just have to click on the orange button on the bottom left-hand side of the screen. And of course, I cannot complete a tutorial without showing you how you can access shows like this. So we've got our own live space right here. Go to Discover, Moo Live. You can see we're live right now. And I can see your comments and also leave you some hearts right there. So leave us a like, leave us a heart, engage with us. I am tracking everything that you type. So type in your questions right now, okay, before we answer them and pick them, and you'll be rewarded with that. So thank you for following through with me on this quick tutorial. But if you have more questions, definitely leave a question down below, or we'll leave an email at the end for you to contact the product team related to this. Let's invite Gunwoo back onto the floor. Welcome back.
Hello, hi. Wow, really nice app. Like you can see our, our fund that we run. I'm surprised.
Yes, I mean, there's just so much they can do. But definitely to learn more about GMO and also yourself and rewatch the replay, right, of this particular show for the latecomers, you can do so on the app and also the insights that Gunwoo was sharing before. Now, I want to jump straight to the first question because now we're on to the second half of the live show. So many questions for you, but I do want to start off with this question. Now, you mentioned diversification a couple of times throughout the live. Now, as a new investor for this space and also given the current market situation, what would you say, is that, key insights on how I can determine the percentage of my own portfolio? So let's say core quality, quality value, and quality growth going into 2024.
Yeah, that's good question, actually.
Yes.
Currently, if you see our portfolio, I would start with, like just, let's say equal weighted the three different bucket that I talked about. And depending on your, valuation opportunity, that probably you will probably see more, value right now at the moment in core quality group or, quality value rather than quality tech because the, quality growth because quality growth has done incredibly well this year. So that could be one way you can think about it, to start from the equal weight, and depending on, valuation opportunity, you could probably tilt in a couple of percentage of the, from the different buckets. So, but the way we are positioned in our current portfolio right now at the moment is that we have about 40% in this quality growth group, and we have about 60% that's split into core quality as well as the quality value group. So that's kind of the split that we have right now.
Thanks for that. Next question is related to, the criteria again. So maybe we could summarize again on your criteria for the new investor coming onto the show, on how they can assess whether that particular investment is worth being a part of this quality investing space.
You're asking the quality criteria I mentioned, how they can come up with the quality. So yeah, I mean, it's actually there are actually, that quantitative screen factor in some sense is actually common. You can see there are other, quality ETFs that kind of does that, use quality, traditional metric like such as high return on capital, high return on equity. That is kind of you're looking at the way you kind of measure the high profitability, and you want to looking at the stability of the profitability is that you look at probably last 5 to 10 years of the ROE or ROIC, whatever the profitability, the measure you choose, you see the volatility around it, how that, high profitability measure has fluctuate over time. And you want probably likely to pick the company that has stable, profitability over time. And, lastly, the capital, the leverage on your balance sheet. And there are, metrics like debt to equity, the assets to equity, that kind of leverage ratio is something, the new investors can play around. And that will throw out pretty, consistent, set of universe that probably you can find from the quality ETF universe. But I think the more importantly, that is half of that equation for that complete quality investing. You need to kind of put your brain around that names and what are the companies that likely with the past winner compared to the future winner. So that is kind of your, like, as a professional investor, that our, that's what kind of we are getting paid for, that having deep understanding of the quality business and differentiate what are going to be the winners versus loser. So that is kind of, I think, the good starting point. Yeah.
Thanks for that. Very helpful for our audience. Now, the next question then, you mentioned to buy high quality companies at an attractive price, as an investor, what would you say you can use as a determination of what the right price is? So they're just worried if they set it too low, they might not get anything. If set it too high, they lose out on potential return. So I think this is just a classic investor dilemma. So what would you say are your insights for this?
So yeah, I would say valuation work is a little kind of tricky. It's art and science at the same time, in the
Right.
sense that if you're talking about what you expect to return on a specific investment or company, if you find an investor that gives you a single number, I probably think that he's not a very great investor, because investing can happen in a very different range of outcome. So when you think about expected return of your investment, you probably better tend to think that of the range of outcome. What are the chances of you getting your kind of best scenario case return versus, if things go wrong with your investment, what are the kind of the return that you will lose? What are the kind of the loss that you can take? So you kind of tend to think that the range of outcome and kind of, if this upside is bigger than the downside, that is kind of like giving you kind of, a margin of safety, and you get more comfort in your investment, right? Compared to where upside is so capped, whereas the downside is, wide, then this is not going to be the good investment. So I would advise investors to think that investment with the range of outcome, with the, kind of a probability of that outcome happening, and kind of think through kind of probabilistic scenario rather than single specific number.
Thanks for that. Now, quiz 2 is about to come, but I'm going to ask this last question before we take the final questions. Now, for AI and these new tech sectors coming up, do you also put that into your decision-making process? And also in terms of the high growth companies, but not yet a profitable company, what is your take on that for the retail investor?
Oh, can you repeat that first part? I kind of missed that.
So someone would like to know, what is your view on a company that has that potential for high growth, but is not yet profitable? And also, what is your stance on AI and these new emerging tech companies in your decision-making process?
That's a good question, actually. So when we talk about like just general investing, not quality investing, that if you identify the winners of that long-term trend, like let's say you buy Apple, like 30, 20 years back before the iPhone was launched, right? You have a great vision, you buy early and just stay through. But, they probably could have made a lot of money out of that, but you don't really have to go for that path that, I have to identify the new emerging, company or the winner of the world that, that will make a lot of money. But instead, what you can do is never really to be late. If you identify that company, like quality company, that one of the nice thing about quality companies that they have navigated through different market cycles and different crises, so that their ability to, that navigate the crisis is a lot better than the company that have just started grow. We have seen a lot of the new emerging company didn't make into that, success and just kind of go bust in the middle, right? And that is kind of the premium that you pay for the quality companies, because you have a track record, you know how to navigate through the crisis, different market cycle. So what I'm trying to say is that never too late on quality companies. It's just that it's the right valuation if you own quality companies that that will likely take care of the rest of your your returns for the future.
Thanks for that. Now it's time for quiz 2, everyone, to reward you for being here with us. We still have a final one at the end, so stay till the end, okay? Now, are you ready for quiz 2, everyone? Type in yes in the chat box right now. Need to see a big yes. Okay, it looks like everyone is very ready. Okay, and here we go. Quiz 2, and go. What can enhance return and downside protection in quality investing? What can enhance return and downside protection in quality investing? We've got some answers. We've got a mix of answers here. I'm curious right now. We've got a good mix of answers. Some right, some potentially wrong. I'm going to give them maybe 10 more seconds. What can enhance return and downside protection in quality investing? So it looks like some got it, some didn't. Let's give it 5 more seconds. Yeah, Gunwoo?
That's interesting. There's an exact answer that I'm looking for, but I give the people answer with the marginal safety is also a correct answer, because they'll be in line with that, valuation.
Yeah, we're gonna go for. You're getting a lot of hearts for this, but we're gonna go for the answer that was given to us by the teams as the correct answer, as the number 1. Okay, so some of you actually got it, so congratulations for that. The correct answer is valuation focus. So congratulations for that one correct answer. But of course, we'll speak to the teams related to who actually got that. But thank you, everyone, for participating. Thank you. Okay, so back to the Q&A. Let's take some last questions for Gunwoo right here. Now, there are many active quality managers and passive ETFs out there for investors to invest in high quality companies. Now, there's 2 parts to this question, okay? So one user would like to know, how is that different from just splitting investments into the S&P 500 ETF, for example, or anything related to that. And the part 2 is then, how is this portfolio different from what others are offering out there?
Yeah, that's a very good question. Like if you kind of replicate the quality strategies S&P or ETF, is that the difference is that S&P is a broad index, so they own a lot of names from different sectors. So there are a couple of sectors that as a quality manager we have hard time finding quality companies, but the benchmark, the S&P, as likes of S&P 500 or Russell they own is the some of the sectors like utilities or like real estate sectors. They are very highly leveraged, low profitability business. So we don't really own the companies from those sectors. So if you buy S&P, you have to own that some of the sector doesn't really fit into quality criteria. And on the other hand, if you buy a quality ETF, that's actually, we are kind of operating in the same space of quality, but we are actually very different portfolio. If you can pull up my slide, I have quite a relevant slide for that specific question. The slide number 16. There are a couple of quality ETFs that depending on which ETF choose, our portfolio is about 50 to 60% different from that, ETFs. Yeah, right there you can see. And I would really, like pinpoint that two specific differences between our portfolio and our quality ETF. At first, because the quality ETF, so-called smart beta passive strategy, tend to use the quantitative model heavily. There are not little or little to no fundamental analysis into that structuring their strategy. So what it really means is that the set of names that they own in the quality ETFs tend to be backward looking in nature in those cases, because they're looking at the past historical performance of their financial data, and they come up with some of the quality universe and create a portfolio around that. But as an active manager with a view on businesses and deep understanding of quality companies, that we do provide forward-looking information into the portfolio. So that's why you can see 50 to 60% of the portfolios are different, because we think that some of the past winners are unlikely to be the winners in the future. And another point is that our strong focus on valuation, because we have valuation a focus anchor in our portfolio, that it allow us to go other spectrum of the quality universe if a part of quality universe over our highly valued. So that's why we have these three different bucket: quality value, quality growth. And depending on the valuation of that company that belong to, we can move around at different types of quality companies that our universe. Whereas quality ETFs tend to heavily focus on tech space, because tech companies have history could demonstrate the most probably attractive quality features in the past, but unlikely they're looking at the valuation of the tech companies to make the adjustment around there. And you can see years like last year, because when markets are down 20%, you expect your quality ETF or quality portfolio to perform better than the market, which we have done it. But if you see that some of the quality ETFs actually didn't really deliver the return that supposed they are deliver, because they don't really pay attention to their valuation. So that strong forward-looking information is a fundamental deep understanding of fundamentals of quality business, as well as the valuation, are the key drivers to our strategy, to the passive strategies.
I think that's a great starter to the next and last question I'm picking for today, because we've got a few similar questions on this. So I'm going to summarize everyone's concern related to this. So, everyone's talking about uncertainty, crisis. I see a lot of these keywords right here. And of course, next year's US situation, I mean, all these changes happening. Yeah. So in terms of expectations and all the different cycles that we're about to enter, what would you say are the sectors that perhaps, they could maybe look upward to? I mean, from GMO's perspective, of course, but I think more importantly, I think on a strategy point of view, what are the picks for quality companies for an active investor?
Yeah, good question. So I think from asset allocation point of view, that because of this uncertainty, and then some of the the valuations of the pockets of markets are really demanding. So I would say you would want to diversify your portfolio going into next year, in a sense that we don't particularly think that qualities are overpriced at current point in time, because at least our quality portfolio own very attractive value quality companies, such as some of the consumer staple names and some of the industrial names that not necessarily has to be tech. Tech is the strong fundamental is still there, but valuation has gotten expensive after strong rally. So when it comes to equity allocation, quality, reasonably valued quality seems to be the safe place to me. And other than equity, we probably want to have some absolute return kind of strategies where we can behave regardless of market cycle, kind of going for absolute return. And also some of the like I would think that 60-40 is good starting point, 60% equity, 40% bonds, and depending on your risk appetite and your view going next year, some of the fixed income allocation, like high emerging asset, that is seems to be the good kind of a mix of equity and bonds in the portfolio going into next year.
Mm-hmm. Thanks for that. Thank you so much, Gunwoo, for sharing your insights and also answering the key questions that we picked from the audience. I still have a lot more questions for you, but that's all the time we have for today. Now, before we go into final takeaways, here is quiz 3 for you guys. If you're ready for that final quiz for today and to round up show 3 of our Outlook series for 2024, type in yes in the chat box so that I know you're ready. Okay, everyone's very ready. So here is quiz 3 and go. Choose the key differentiators between GMO's quality strategy and other quality strategies. Is it A, B, C, or D? We've definitely covered everything, especially during the live Q&A. Is that right, Gunwoo?
I think so. How everybody get it right?
So what would you say is the answer? Let's have a look. Let's have a look at the range of answers.
There you go.
Okay, everyone's great. Give us a thumbs up, everyone, and a heart if you think you got it right. Yes, I see a lot of interaction. I love it. There's so much support and engagement right here. If you think you got it right, give me a thumbs up or a heart. All right, so the correct answer is all of the above. So if you answered D, congratulations. Our teams will be in touch on the winners, okay, for this. Great stuff. Okay, Gunwoo, just to round up our chat discussion on quality investing and time-tested approaches. Now, what would you say is your final takeaway for the audience today?
Yeah, thanks for your time today. I really enjoyed the show. And I think my last point that I want to make is that, our quality portfolio is actually, we think that really 3 key differentiator. GMO, is a pioneer in quality investing. We have researched the quality investing intersection of the value and quality over 40 years. And we have 20 years, almost 20 years of a live track record that we have delivered that investing successfully. I'm very proud of that. And secondly, our focus on valuation are the really key differentiator. A lot of people claim that, we do quality reasonable, price and type of investing, but you can see who's swimming naked when the tide goes out. Last year was a classic example. We have delivered the performance that better than market because we pay attention to valuation heavily. And lastly, our unique, investment process using both quantitative as well as the fundamental analysis are the kind of the differentiator factor. And we believe that we can, continue to deliver what we have delivered in the past, in the future. Thank you so much.
That was portfolio strategist on GMO's Focus Equity team, everyone. Gunwoo Lim. Thank you, Gunwoo, for being here with us. And hopefully next year, it's going to be this is just a start of many that we have with you. See you next time.
Thank you, Olivia. Bye-bye.
Thank you, Gunwoo. Now to the audience, thank you for being here with us. I see a lot of energy, enthusiasm in the chat box. Keep them coming. Give me a thumbs up and the hearts. I love it so much. And also for your questions, it's great to see a lot of people typing in all your insightful questions that you want to know. Now, this is not the end. This is just the middle of our series crafted for you for 2024 Outlook. Now, if you want to follow and be up to date, do connect and follow us right here. Scan the QR code right here, wherever you're tuning in from, for the fund houses and also more information on where you can get access to these details. And next up, if you want to have more content as well, or if you're submitting questions to me and you want to see some topics for discussion, do scan my QR code right here. And also our social media channels. We're on everything. So if you want to join our Telegram group, we've got TikTok, YouTube, and also Instagram on here. So join us and also follow our Twitter pages if you want to have more information whenever we go live. There's so much content just for you. So definitely scan the QR code to be at the forefront of everything. Okay. And of course, as promised, you'll see the email at the end, but that's our client service email. So if there's anything product related, do submit a question there. We'll see you tomorrow for our next show on embracing the storm for 2024 opportunities. I cannot wait to see more discussions and see where it takes us tomorrow. So definitely join us, and I'll see you next time. Once again, I'm Olivia Higgins. Happy investing, everyone. Okay, perfect.
Oh, how did it go?
You can breathe now.
Yeah, how was